All right. Intuit reported second quarter results for 2026 today. Part of the portfolio, part of the techno feudal empire, so to speak. The idea is to own platforms that have dominant market share in companies that people are increasingly dependent on and are unlikely to stray from because it would make their life too annoying. So Intuit offers TurboTax, Credit Karma, QuickBooks, and MailChimp. And the main so today I thought it would be a good idea to go over how I analyze an earnings report. Um, so this is what the earnings report looks like from their actual website, which I usually just scroll straight down to these tables for the financials, but even that is less useful because of this website stock analysis. I like how um, this website, how it lays things out um, a lot better. Um, so I'm just going to go over that in this video. So first thing I'll look at is you want to make sure that the revenues are still growing. Because if your revenues aren't growing, that means that the influence of the company, like the health of the company, is at huge stake. The influence of the company is being reduced. They're losing sales to competitors. They can't afford to raise prices. There's a lot of implications to revenue no longer growing. If revenue, in fact, today I sold Altria because it was the only company in my portfolio. It's a tobacco company in Virginia. Uh, it was the only company in my portfolio that didn't have increasing sales. So I had to stick to my philosophy and sell it and move that money elsewhere. Now I had a decent gain from the investment, so it wasn't a big deal. But you have to always remind yourself, like, okay, like this it doesn't fit my criteria or my philosophies. So main criteria is growing sales. It's actually more important to me than growing profits because expenses happen, random things happen, shit happens. But if you have growing sales, that means going forward it'll be much easier to manage the growing expenses. So one thing I love about stockanalysis.com is how you can get um, this long-term visual, like this upward trajectory of sales is very healthy. Now the spikes is because of tax season. A big product that this company offers is TurboTax, and when everyone's filing their taxes, which is a specific time of year, they have like double the sales. So that's what that's about. Um, Operating income basically just does all the math for you. It takes all the profits, subtracts all their expenses, bam, and you could see Q2 compared to last year, 597 million to 855 million. It's good. It's a good rate of increase. Interest expense, they're slowly paying down their debt, but there's no rush to. Uh, so net income, I mean, super healthy looking. Upward trajectory. In fact, the net income is growing quicker than the revenue. And then, so they're growing their sales. They're being more efficient about how expensive it is to achieve those sales is becoming more efficient. It's becoming less expensive to achieve the sales, increase profitability, and reduce share count. So you have a higher increase in profits than revenue. Then you have a higher increase in EPS than profits because there's less shares. You can see they're buying back shares. That's what this green the green means it's a good thing. There's less shares. Earnings per share of 50% from last year. So we went from 1.69 EPS to 2.49 in 1 year. You can't complain. Not too shabby. Free cash flow is improving. Gross margin 80%. It's amazing. That means that as they increase their sales, their cost of revenue is very low. That's what this is. It's the margins on the variable expenses instead of the instead of the fixed expenses. Like gross margin, this is your revenue minus your variable costs. Operating margin, this now subtracts not only your variable costs but also your fixed costs. And then this is, everything else. Interest expense, like investment income. The difference between operating margin and profit margin is everything that happens after the operations, like interest on your debt and money you make from investments. So, balance sheet. So, income statement analysis. Clean. Now, you can also go to annual here so that you don't see those spikes in the quarters. Very healthy. Rising sales. They don't seem to be, if they're losing customers, they're gaining them at a much quicker rate than they're losing them. I have an unpopular opinion that this asset column is balance sheet analysis needs we have to reassess the importance and methodology behind balance sheet analysis, because I think so many of these tech platforms, their assets are they're not priced correctly. It's hard to describe. Like they're generating way more earnings. Like how are they evaluating some of these assets? Like Instagram. Like there's no physical building. Like it's hard to describe. It doesn't seem like we're pricing assets high enough if they're like internet based, rather than brick and mortar, like physical factories and shit. Which makes like the book value per share, like a bunch of analysis kind of gets thrown off. One thing I pay attention to a lot though in the balance sheet is the retained earnings. You want to make sure that these are continuing going up, because ultimately, like, this is where the stored value of the company is. Cash flow. So I analyze the cash flow to assess share repurchases and dividends. Share repurchases are at a record. They did more share repurchases this quarter than ever. Not too surprising when you look at the graph. The people running the company are paying as much attention to this graph as the investors, and when they see this, I mean, they're going to be, when the share price plummets, they're going to be more likely to do buybacks, and so it's not surprising at all to see an increase. And then, I like to go to this dividend tab. I like to see a payout ratio of around 20 to 30%, because I want you want to make sure they're not like eating their own tail and paying out dividends they can't afford to. Which, like, if this is like 90% or higher, 80% even, like depending on the industry, of course, you want to make sure this isn't too high, because that means they can't, like, yeah, the dividend might be high, but they can't afford it. Dividend's been growing for 15 years. They're doing some buybacks. Like, I like dividend yields around 1-2%, because if it's too high, that means the PE is low, which means there's a reason the PE is low, or it means their payout ratio is too high, which means they're a snake eating their own tail. Like, they can't afford to pay that dividend, but they can afford to pay this dividend and still be growing as a company. You can go to this forecast area and you can see your average analyst. It's like the, the median analyst prediction for a year from now is for this to double a year from now. Go from 394 to 758. Of course, no one knows the future, but it's kind of interesting to check this out. You can come here and see the certain metrics, revenue, operating income. But yeah, I just wanted to do a quick video showing like what I do when an earnings report comes out. You know, the first thing you come here, okay, good, revenue's still growing, relief. Okay, our expenses aren't increasing, like the expenses are, they're managing their expenses. It's ironic, we pay taxes on doing people's taxes. Yeah, everything's good, you know, so it's staying in the portfolio. Forward PE 16. Not too overvalued. Market cap 111 with a revenue of 20 billion. Yeah, still bullish. There's a lot of people out there who are upset with TurboTax. They're switching to like Free Tax USA. But I don't know. Like, the people who complain are the most vocal. The people who are happy or neutral aren't vocal. And the sales, like, this proves that more people are staying than leaving. So, yeah. So yeah, that's just a quick earnings analysis today of Intuit. Let me know what you think. Please like and subscribe if you made it this far. Yeah.